Hi traders, do you ever feel overwhelmed by multi-time frame analysis, seeing one thing on the 5-minute chart, but something completely different on the hourly? You're not alone. Most traders get lost in conflicting signals and struggle to make sense of it all. In this video, I'll break down a simple 2-time frame strategy that clears the confusion and reveals exactly how to align your trades with the big players' moves. Now, let's break down why top-down analysis is essential for your trading success. One of the biggest benefits of top-down analysis is that it helps you align with smart money signals and avoid fake zones that could lead to losses. Here's a great example. Let's say you're analyzing the US dollar Canadian dollar on the 5-minute chart. You spot what looks like a strong supply zone, and as the market approaches, there's a clear rejection, making it seem like the price is set to move down. It might look like a great short setup at first glance. But before jumping in, let's zoom out to the hourly chart. Here we see something important. A key support level was broken, but then price quickly reclaimed it, closing back above. This pattern is what we call a liquidity sweep, a classic smart money move designed to trap sellers by breaking below a support level, triggering stop losses, and then reversing upwards. This signal suggests that the bigger players are pushing the price up, not down. Now, if we return to the 5-minute chart with this higher time frame context in mind, we recognize that the supply zone is likely a fake setup, part of the trap set by smart money. By ignoring this short trade, you avoid being caught in a reversal that would have gone against you. Without top-down analysis, you might have taken the short position and been blindsided when the market moved up. This approach helps you trade in line with the bigger players and avoid the traps that can otherwise lead to quick losses. Top-down analysis keeps you aligned with the market structure. By starting with higher time frames, you catch the key levels and trends that aren't visible on lower charts, helping you avoid trades that clash with the market's dominant direction. Here's a great example of why top-down analysis is crucial. Let's say you spot a bearish setup on the hourly New Zealand dollar US dollar chart, a strong breakout, tempting you to go short. But let's take a step back and check the daily time frame. On the daily, we see a different story. The market has been trending up, then consolidating, forming a clear demand zone. In fact, the price was recently rejected from this zone, suggesting an upward move is likely. Now that we've marked this zone, let's return to the hourly chart. That breakout may still look appealing, but now we know it's sitting within a demand zone on the higher time frame. This means the breakout is probably just a pullback, and taking a short trade here could put you against the bigger trend. Without this top-down analysis, you might have jumped in and been caught off guard when the market reversed. By using the full picture, you filter out trades that go against the dominant structure, keeping you aligned with the market. Top-down analysis helps us avoid low reward to risk trades and spot the end of short-term trends. Let's take a look at the Canadian dollar Swiss franc 5-minute chart. Here we see the market trending up strongly, breaking through resistance levels that then turn into support. It's tempting to think this upward trend will continue, so we might feel like jumping in for a buy trade. But let's check the 1-hour chart before we commit. On the hourly, the market is indeed in an uptrend, but it's approaching a major resistance level and a strong supply zone. These higher time frame levels act as potential reversal points where price could turn down sharply. Now, let's return to the 5-minute chart with this new insight. With that hourly resistance and supply zone in mind, it becomes clear that entering a buy trade here might be risky. Our target would logically be the supply zone, but that would mean a low reward to risk ratio since the target is close by. This setup doesn't align with our goal of high reward to risk trades, so it's best to avoid this one. And look what happens when price reaches that supply zone. The market reverses just as expected. Without top-down analysis, we might have entered this trade and been caught off guard by the reversal. By analyzing both time frames, we protect ourselves from setups that look good on the surface, but don't hold up when we see the bigger picture. Now that we understand why top-down analysis is essential, let's dive into how to actually conduct it step by step. First, let's talk about a common approach that I call the crowd technique, because it's the method most traders use. This approach involves multiple time frames, but it often leads to more confusion than clarity. I'll show you why, and then we'll dive into a more effective, streamlined method for top-down analysis. The crowd technique works like this. First, traders start with the weekly chart to get a big picture view. They mark key support and resistance levels, thinking this will help them understand the overall market direction. Next, they move down to the daily chart to refine those key levels and look for possible trade setups. Here, they try to narrow down opportunities by focusing on how price moves around those weekly levels. Finally, they switch to a lower time frame, like the 5-minute or 15-minute chart, to find the perfect entry point. At this stage, they're looking for specific patterns or candlestick signals to time their trade. While this method can seem thorough, it's usually overwhelming. The crowd technique often results in charts cluttered with too many levels and zones from different time frames, making it hard to stay focused and increasing the chances of hesitation or confusion. By trying to analyze everything, traders can end up missing the bigger picture or getting lost in unnecessary details. In my experience, the best top-down analysis approach is what I call the dynamic top-down analysis. Unlike the crowd technique, which can feel overwhelming with multiple layers, dynamic top-down analysis uses just 2 time frames. This approach keeps your chart clear, helps you focus on the essentials, and allows you to make decisions based on key levels without unnecessary noise. Here's how it works. With dynamic top-down analysis, you only need 2 time frames to keep your trading focused and effective. Start with a higher time frame to find the most important levels in the market. This includes key support and resistance levels, supply and demand zones, and order blocks, all areas where price is likely to react. These levels give you a roadmap and help you stay aligned with the overall market direction. Once you've marked key levels on the higher time frame, switch to your lower time frame to look for specific trade setups and entries. This is where you'll identify setups that align with the levels you marked, filtering out unnecessary noise and focusing on entries that match the bigger picture. Here's how to choose your time frames. If you're trading on the 5-minute or 15-minute chart, use the hourly chart as your higher time frame. If you're trading on the hourly chart, use the daily as your higher time frame. If you're trading on the 4-hour chart, use the weekly as your higher time frame. With this simple 2-step method, you're able to pinpoint entry opportunities that align with the key levels from the higher time frame, creating a focused, clear, and dynamic trading approach. Let me walk you through a powerful example of how dynamic top-down analysis can help us validate a trade setup on the Euro-Canadian dollar 5-minute chart. We start on the 5-minute chart, where we spot a potential bullish order block. Several factors confirm this order block as valid. First, we have a break of structure, where the price has broken above a recent level, signaling upward momentum. Next, there's a fair value gap, a space between recent candles which suggests an area where the price might return before continuing higher. Finally, this is an unmitigated order block, meaning it hasn't been retested yet, so it's still fresh and holds potential. So we draw our order block and wait for the price to pull back into the fair value gap and retest the order block. As anticipated, price returns to this area and shows a slight rejection, giving us a solid entry signal. Now that we spot our entry on the lower time frame, we switch to the hourly time frame to see the bigger picture. On the hourly chart, we find a few key details. First, there's a major resistance level just above, along with a strong supply zone. Recently, the market broke through this resistance and moved past the supply zone, which suggests there could be some upside momentum building. With this higher time frame context, we have a clearer picture of the market's intention, adding confidence to the setup we've identified on the 5-minute chart. Now that we spot our levels on both time frames, we return to the 5-minute chart to set up the trade. For our entry, we'll wait for the price to pull back to the order block and show signs of rejection before entering the trade. Our stop loss goes just below the order block to keep it protected. As for our target, we're aiming for the next key resistance level identified on the hourly chart. Because we know that big players have already broken through it on the higher time frame, and what we're seeing now on the 5-minute chart is likely just a small retracement. This setup gives us a 3-to-1 reward to risk ratio, aligning perfectly with our risk management strategy. As we anticipated, the market respects our analysis, moving up and hitting our target at the key resistance level. This trade setup played out well due to the combined insights from the 5-minute and hourly charts. By using 2 time frames, we identified key levels, understood the larger market intention, and took a high probability trade with confidence. This is the power of dynamic top-down analysis. It simplifies the trading process and keeps you aligned with the market structure. Now, regardless of your strategy, whenever you switch to a higher time frame, it's essential to identify key levels like support and resistance. We spot these levels on the higher time frame so that when we switch to the lower time frame, we can see if our trade aligns with them, or if it's likely to face a strong level that could cause a reversal. There are 4 criteria that we look for when identifying key levels of market structure, and each one of them makes a level more powerful. Key levels at extreme swing highs and lows, Key support and resistance levels are often found at the extreme points on a chart, swing highs and swing lows. A swing high is the peak of a price move, where the market reached a temporary top before reversing. A swing low is the opposite, a low point where price bottomed out before moving upward. When identifying these levels, focus on the most noticeable peaks and valleys on the higher time frame chart. These extremes usually mark areas where buyers or sellers made a strong move, so they're more likely to act as important support or resistance levels. Key levels with multiple price rejections. Another strong indicator of a key level is seeing multiple rejections at the same price. This means that the price has approached this level several times and has been pushed back each time, showing that it's a significant level for buyers or sellers. When price repeatedly touches a level and is unable to break through, it tells us that there's a strong buying or selling interest at that price. The more times a level is rejected, the more important it is, as it signals a clear barrier where buyers or sellers are stepping in. Key levels that are recently respected or recently created. Recent levels, those that the price has recently reacted to, are also highly relevant. These levels are fresh in the market and tend to have more impact because they show where buyers and sellers were actively defending or challenging price within recent sessions. Recently respected or created levels often carry strong momentum and can provide clear entry or exit points when trading on a lower time frame. Key levels that have acted as both support and resistance. A very reliable indicator of a key level is one that has acted as both support and resistance at different times. For instance, a price level might have initially acted as resistance, rejecting price moves upward. Later, when price breaks above, that same level may act as support. This role reversal is powerful because it confirms that the level is significant in the market. It means both buyers and sellers recognize its importance, making it a strong level to watch for future trades. Okay, here's an important note. When drawing key support and resistance levels, always use the wicks of the candles, not the bodies. Position these levels where you see the most touches from price action. This adds strength and accuracy to your analysis. Now let's see some real chart examples to put these concepts into action. As you can see here on this 5-minute chart, we have two strong reasons to consider this setup a high probability trade. First, we have a clear demand zone. This large green candle signals that smart money was behind this move, making this zone highly significant. Second, we see a liquidity sweep. Notice how the market briefly broke below the demand zone, hitting stop losses placed there, and then closed back above the zone. This creates a powerful combination of two smart money strategies: supply and demand and liquidity sweep. Now, we have a clear buy signal on this lower time frame, but let's check if the higher time frame aligns with our trade. On the higher time frame, we see that the market was previously ranging, but then made a strong breakout above a key resistance level. This breakout tells us that the big players are likely aiming to push the market higher. Returning to the 5-minute chart, we know that smart money intends to drive the price up, and the next key resistance level that could reverse our trade is far enough away, giving this setup a strong reward to risk potential. So we place our entry at the close of the pin bar that triggered the liquidity sweep, with a stop loss below the demand zone and a target at the next resistance level. Look at what happened. Just as anticipated, the market moved in our favor and hit our target. Now let's look at another example. Here we have the Euro-British Pound 4-hour chart, an ideal setup for swing traders. As you can see, the market is ranging, and we have a clear key support level. Notice how the market has tested this support level multiple times. Then, the price breaks below the level, only to close back above it. This is a classic liquidity sweep. Smart money hits the stop losses of breakout traders, creating a false breakout, and then the price strongly rejects and closes above support. This liquidity sweep is a footprint left by market makers, signaling that sellers were trapped, and the market is likely to move up from here. As smart money traders, this gives us a great buying opportunity since liquidity sweeps often indicate a strong upward move is coming. But before we take the trade, let's confirm our plan with the higher time frame. We'll switch to the weekly chart, which is the higher time frame for our 4-hour setup. On the weekly chart, we also see a ranging market, and the price was recently rejected from a key support level. The last candle is a strong bullish candle, suggesting that after this rejection, the market is likely to continue upward, potentially reaching this supply zone. By analyzing the higher time frame, we gain insight into the intentions of the big players in the market, which aligns perfectly with our buy setup. Returning to the 4-hour chart, We now have a solid trade plan. The weekly support level will serve as our stop-loss level, providing a solid exit point if the trade moves against us. Our target can be set at the short-term resistance level just before the supply zone. In this case, I'll be more conservative and use the closer resistance as our target, which gives us a reward-to-risk ratio of 2.5 to 1. Now, look at what happens next. The market hits our target and continues to move up towards the supply zone identified on the weekly chart. This example highlights how analyzing the higher time frame supports our trade idea, offers clearer risk management, and ultimately boosts our confidence in the setup. I hope this deep dive into top-down analysis has given you valuable insights and tools to improve your trading. Remember, staying aligned with the bigger picture and following these steps can make a real difference in your success. If you found this video helpful, please give it a thumbs up, subscribe for more trading content, and feel free to drop any questions or thoughts in the comments below. Happy trading, and I'll see you in the next video.